Welcome to the Deep Dive, the show where we take your essential materials and unpack them piece by piece, giving you that shortcut to being truly well-informed. Today, our mission is specifically tailored for you, our listener, as you prepare for an upcoming case-based exam. We're about to embark on a crucial journey through the intricate world of audit planning, strategy, and execution. Now, you might think auditing sounds, well, a bit dry maybe, but we promise you, it's anything but. Beyond all the definitions, there's a fascinating logic at play, a real art to ensuring financial integrity and building trust. For your exam, the goal isn't just memorization. It's about deeply understanding and retaining these concepts so you can apply them effectively in real-world scenarios, just like you'll face in those case studies.
Precisely. Yeah, this isn't about rote learning at all. Our commitment today is to distill every key concept from your provided material using the precise terminology you'll encounter on your exam, and then showing you exactly how these ideas come to life in practical and exam-style situations. We'll even dissect a comprehensive case study, just like the ones designed to test your application skills.
Okay, to really kick things off, let's dive into a scenario that brings the complexities of audit planning into sharp focus right from the start. Imagine CAB, a newly qualified chartered accountant, taking on the audit of a really cutting-edge fintech company. This company thrives on big data, AI, and is even eyeing blockchain technology. They're operating within a regulatory sandbox, meaning they're live testing new financial products and services in a controlled environment under regulatory supervision. Immediately, CAB feels a strong need for an expert IT specialist. He's thinking, about gaining insight into their complex IT controls and the myriad IT laws and rules that govern such a tech-laden company. But this simple need sparks a whole cascade of critical questions, doesn't it? Does involving an expert even factor into his overall audit strategy? Does it somehow dilute his responsibility as the auditor? Should he formalize an agreement with this expert, clearly outlining the nature, scope, and objectives of their work? And crucially, what about confidentiality with such incredibly sensitive financial data and proprietary systems? Bringing in an expert to understand controls could expose the company's core systems and sensitive data. Could that even amount to a violation of the professional ethics principle of confidentiality? On top of all this, CAB is new to this industry and needs to quickly grasp broad regulatory requirements from the RBI, the Ministry of Electronics and Information Technology, MINI Authority under the Digital India program, and even understand schemes like the Ombudsman Scheme for Digital Transactions, which outlines how consumer complaints are handled. It's a lot to navigate.
It really is. And what's truly fascinating here is how quickly the theoretical framework of auditing standards becomes intensely practical. This opening scenario, drawn directly from your material, perfectly illustrates the core challenges of audit planning. You need to understand a new client's business inside and out. Identify the need for specialized expertise, navigate critical ethical considerations like confidentiality, and recognize all relevant regulatory frameworks. It immediately highlights that knowing your client's business isn't just a suggestion, it's the foremost requirement for developing a robust audit plan. This foundational understanding is what informs every subsequent decision you make as an auditor.
Okay, let's unpack this. We're going to cover the entire journey, from establishing the overarching audit strategy to the granular nuances of audit execution. We'll explore how auditors utilize the work of others, be it internal auditors within the company, other external auditors handling different components of a group, or specialized external experts like our IT professional for CAB. We'll also deep dive into the complexities of auditing accounting estimates, grappling with the inherent uncertainty and potential for management bias, and the crucial role of analytical procedures. Get ready for an insightful, practical exploration that should really solidify these concepts for your exam. So our deep dive journey begins with the bedrock of any successful audit planning. Your material emphasizes that planning an audit involves establishing the overall audit strategy for the engagement and developing an audit plan. But why is this so crucial? Why dedicate so much time and effort up front? What are the several ways adequate planning truly benefits the audit of financial statements?
Right. Think of robust audit planning as your audit strategic roadmap, or maybe like a GPS system. It ensures you don't just wander aimlessly through financial statements, but rather strategically focus your energy where it matters most. Your source lists 6 key benefits, each reinforcing the idea of a structured, efficient, and ultimately more effective audit. Firstly, it ensures attention to important areas. Planning means the auditor devotes appropriate attention to important areas of the audit. This isn't about superficial scrutiny, it's about allocating resources to high-risk areas or material components. For our fintech example, this would mean dedicating more time and specialized resources to understanding their complex data systems and AI algorithms rather than, say, routine cash transactions. It prevents you from getting lost in the weeds where the real risks aren't. Secondly, planning enables timely resolution of potential problems. By identifying potential problems on a timely basis, planning allows for proactive solutions rather than reactive damage control. This is absolutely critical in complex audits like our fintech example, where novel technologies might present unforeseen challenges that could derail the audit if not addressed early in the planning phase. You're anticipating hurdles before you hit them. Thirdly, it facilitates proper organization and management of audit engagement. A well-laid plan provides a clear roadmap for the entire engagement, enabling proper organization and management. Think of it as a blueprint that keeps the audit on track, ensuring all necessary steps are completed efficiently, especially for large, sprawling entities with multiple teams or locations. It's about efficiency and coherence. Fourthly, and this directly speaks to CAB's initial dilemma, it ensures the proper selection of engagement team and involvement of experts on complex matters. Planning helps you identify who you need on your team members with the right experience and expertise, or even the external involvement of experts on complex matters, like IT controls, as your material states. This is crucial for matching the audit team's skills to the client's business and specific risks. You wouldn't send a financial expert to audit a complex IT system without specialized support, right?
Right. Makes sense.
Fifth, planning provides essential direction and supervision of engagement team members. A clear plan ensures consistency, quality, and adherence to the audit objectives throughout the process. This is especially vital when multiple team members are involved, ensuring their work is cohesive and meets professional standards. Everyone knows their role and the overall direction. And finally, it allows for easy coordination. For audits involving multiple entities, components, or specialized fields, planning enables easy coordination and work done by auditors of components and experts. This is vital for consolidated financial statements or when relying on external specialists, ensuring everyone is working from the same page and toward the same goals, minimizing friction and delays.
That paints a very clear picture. It's about being strategic and proactive, basically.
Yeah.
Your material also points out that the nature and extent of planning isn't a fixed thing, it varies. What drives that variation? It mentions size and complexity of the auditee, past experience and expertise, and change in circumstances. How do these factors shape the planning process?
That's a great point. The audit plan is absolutely not a one-size-fits-all document. Its tailoring is crucial for effectiveness. It needs to be bespoke to each engagement. First, consider the size and complexity of the auditee. A large and complex organization, like our fintech example with its cutting-edge tech and regulatory sandbox activities, naturally demands much more planning activities than, say, a small local retail store. The sheer volume of transactions, the intricacy of their systems, the breadth of their operations, it inherently requires more extensive and nuanced planning. More moving parts mean more planning. Second, past experience and expertise. The previous experience and expertise of the key engagement team members can significantly alter the planning approach. For example, if your audit team has extensive prior experience in the fintech sector or with blockchain, they might spend less time on basic industry understanding and more time on the cutting-edge aspects unique to this specific client. Familiarity allows for a deeper, more efficient focus, but it doesn't negate the need for thorough planning for the current year's specifics. No two audits are identical.
Right, circumstances change.
Exactly. And third, change in circumstances. Audits are dynamic endeavors. Change in circumstances, be it shifts in the entity's business model, changes in the regulatory environment, like new RBI or MADI regulations impacting fintech, or even evolutions in internal controls, necessitates continuous adaptation of the plan. This highlights a critical point from your material. Planning is not a discrete phase of an audit, but rather a continual and iterative process. It evolves as new information comes to light, making it a living document that responds to the realities on the ground.
So it's truly a living document. Your material highlights that planning often begins shortly after, or in connection with, the completion of the previous audit and continues until the completion of the current audit engagement. What key matters does this ongoing planning include consideration of before the auditor even dives into identifying and assessing risks?
Okay, before we get into the nitty-gritty of risk, the auditor has several foundational matters to consider. These are like setting the stage before the play even begins. Firstly, thinking about the analytical procedures to be applied as risk assessment procedures. This involves initial high-level reviews of financial and non-financial data to spot unusual trends or significant fluctuations. These early analytical insights can act as a radar, highlighting areas where risks might be lurking before you even formalize your risk assessment. Secondly, obtaining a general understanding of the legal and regulatory framework applicable to the entity and how the entity is complying with that framework. This is a direct echo of CAB's situation, where he needed to quickly grasp the complex fintech regulations from RBI and MAIDI and understand schemes like the Ombudsman for digital transactions. Without this foundational understanding, it's simply impossible to assess compliance risks or the completeness of disclosures. Thirdly, the determination of materiality. This is a pivotal decision made early on. Establishing materiality levels upfront defines what is considered significant enough to influence the economic decisions of users of the financial statements. This threshold then guides the entire audit scope, influencing how deep you go and what level of misstatement you aim to detect.
Crucial step.
Very. Fourthly, the involvement of experts. Just as CAB considered, deciding whether specialized expertise, like an IT specialist for complex systems or an actuary for pension liabilities, is needed to address complex areas is an early planning consideration. It directly impacts your resource allocation and overall audit approach. And fifthly, the performance of other risk assessment procedures. This is a broad category encompassing all the initial steps taken to comprehensively understand the entity and its environment, its operations, its industry, its objectives, and its internal controls to proactively identify where material misstatements might occur.
That brings us to a really interesting distinction: the overall audit strategy versus the more detailed audit plan. Your material stresses that while discussions with management are common for coordination, the overall audit strategy and the audit plan remain the auditor's responsibility. Why is that singular responsibility so important, and what's the danger if audit effectiveness is compromised?
This point goes right to the heart of the auditor's independence and professional skepticism. The auditor's independence is absolutely paramount because it ensures objectivity and credibility in their opinion. Yes, discussing elements of planning with management can facilitate the conduct and management of the audit engagement. For instance, coordinating planned audit procedures with the client's internal timelines or staff availability. However, care is required in order not to compromise the effectiveness of the audit. The danger here lies squarely in predictability. If you, as the auditor, were to discuss the nature and timing of detailed audit procedures with management, it may compromise the effectiveness of the audit by making the audit procedures too predictable. If management knows exactly when and where you'll be looking, it could create an opportunity for manipulation or concealment, effectively rendering your audit procedures less effective. Therefore, maintaining the audit strategy and plan as the auditor's sole responsibility is a fundamental safeguard for the integrity and surprise element of the audit process.
That's a sharp distinction. So maintaining that independent perspective is key. And who specifically should be involved in shaping this crucial planning process?
Well, it's a team effort, but with specific leadership. The engagement partner and other key members of the engagement team should be involved in planning the audit. Their collective experience and insight are vital for enhancing the effectiveness and efficiency of the planning process. This ensures that the planning benefits from a range of perspectives and a deep understanding of the client, its industry, and the specific risks involved, particularly for complex or high-risk areas. Their involvement ensures the strategy is robust and well-informed.
Before even getting to the strategy and plan themselves, your source highlights acceptance and continuance of client relationships and audit engagements as very important preliminary engagement activities. What exactly does an auditor need to do at the beginning of an engagement regarding SA 220, ethical requirements, and engagement terms?
Right. This is essentially the auditor's gatekeeping function, ensuring you're in a suitable position to perform a quality audit right from the outset. At the beginning of a new or continuing audit engagement, the auditor must undertake these critical preliminary activities. Firstly, perform procedures required by SA 220, quality control for an audit of financial statements, specifically concerning client continuance. This involves evaluating information that helps determine whether accepting a new client or continuing with an existing one and the specific audit engagement is appropriate. It's a continuous assessment that often starts shortly after the completion of the previous audit. Secondly, and this is foundational, evaluate compliance with ethical requirements, including independence as required by SA 220.
Yep.
Independence isn't just a rule, it's the bedrock of the audit's credibility and objectivity. Without a rigorous and ongoing evaluation of independence, the audit opinion holds little value. And thirdly, establish a clear understanding of the terms of the engagement as required by SA 210. This is typically formalized through an engagement letter. This letter explicitly outlines the responsibilities of both the auditor and the client, the scope of the audit, the applicable financial reporting framework, and the overall objective of the audit. Establishing this understanding early prevents any misunderstanding with the client regarding the nature and limitations of the audit, setting clear expectations for everyone involved.
That says a very clear framework. Now, let's talk about the actual contents of an audit plan. What precisely should this granular roadmap describe?
The audit plan is indeed the detailed playbook for the audit procedures. Your material specifies it, shall include a description of, firstly, the nature, timing, and extent of plan risk assessment procedures as determined under SA 315, identifying and assessing the risks of material misstatement through understanding the entity and its environment. This means detailing how the auditor will build their understanding of the client's business, its internal controls, and its environment to pinpoint where risks might occur and what their likely magnitude is. Secondly, the nature, timing, and extent of planned further audit procedures at the assertion level, as determined under SA 330, the auditor's responses to assessed risks. Let's break down assertion level for a moment. These are the specific claims management makes about the financial statements, like all sales recorded actually happened, occurrence assertion for transactions, or all assets listed actually exist, existence assertion for balances, or all liabilities are complete. Completeness assertion for disclosures. So this part of the plan details the specific tests of controls and substantive procedures designed to respond to the risks identified under SA 315 at that granular assertion level. And thirdly, other planned audit procedures that are required to be carried out so that the engagement complies with SCs. This encompasses any other procedures mandated by auditing standards that aren't necessarily directly tied to assessed risks, but are essential for a compliant audit, such as evaluating going concern or communicating with those charged with governance. This level of detail makes the audit plan significantly more specific and actionable than the overall strategy.
So it's much more detailed than the overall strategy. Does it stay static once it's set, or can it change?
Oh, it's absolutely dynamic. The auditor should update and change the overall audit strategy and the audit plan as necessary during the course of the audit. This flexibility is crucial because an audit isn't performed in a vacuum. It's a discovery process. Changes happen due to unexpected events, changes in conditions, or audit evidence obtained that differs significantly from initial expectations. For instance, if audit evidence obtained through the performance of substantive procedures may contradict the audit evidence obtained through tests of controls, the auditor must reevaluate their initial assumptions about internal control effectiveness and modify the plan. This could mean adjusting the scope or type of procedures. Even external factors like a change in law notifications, government policies, think about new fintech regulations for CAB's client, can warrant modifications to the strategy and plan. The auditor must remain agile and responsive to new information and findings as they emerge.
And what about documenting all this? What's the purpose of documenting the strategy, the plan, and any changes that occur?
Documentation is vital. Vital for accountability, clarity, and demonstrating compliance with standards. It's your audit trail. Firstly, it serves as a record of key decisions. The strategy documentation is a record of the key decisions considered necessary to properly plan the audit and to communicate significant matters to the engagement team. This ensures consistency and understanding among all team members, especially important for large, dispersed teams. Secondly, it's a record of procedures and planning. The audit plan documents the plan nature, timing, and extent of risk assessment procedures and additional audit procedures. It also serves as a record of proper planning, ready for review and approval before execution, allowing for effective quality control. It shows you thought it through. And thirdly, it's a record of reasons for change. Documenting significant changes to the strategy and plan, along with their reasons, explains the evolution of the audit. This demonstrates that the auditor is making an appropriate response to the significant changes occurring during the audit, rather than arbitrary adjustments. It's crucial for justifying modifications to the audit approach and ensuring transparency for reviewers.
We have a test your understanding scenario from your material here about CAP. An auditor who never visited the client, failed to understand the business, and used general checklists. What does this reflect about his planning?
Oh boy. This is a classic textbook example of poor planning and a blatant disregard for professional standards. SA 300 requires the auditor to plan the audit in such a manner that it is performed effectively. CAP completely flouted this fundamental requirement by failing to understand the business of the company. Your material emphasizes that the auditor must plan the audit commensurate to the nature and complexity of the business. His working papers lacking business understanding are a blatant violation of requirement of SA 300, which mandates documentation of the overall audit strategy and plan, clearly outlining how the engagement scope is defined by the entity's characteristics. Furthermore, using a general checklist without tailoring it to the specific business, like test checking raw material and stores for a commodity futures trading company, further demonstrates a failure to conduct the audit in an effective manner. It shows he didn't properly identify the characteristics of the engagement that define its scope, which is a key aspect of establishing the overall audit strategy. This lack of tailored planning directly impacts the quality and effectiveness of the audit, rendering it insufficient for forming an opinion.
Yeah, definitely not best practice. Okay, once the overarching strategy and the detailed plan are in place, the next crucial step is the audit program. Your source describes it as the blueprint commonly prepared to allocate work to team members, including a list of audit procedures and instructions to be followed by the member. It even estimates the duration for completing an audit task. So how is an effective audit program actually formulated? What are the practical considerations?
Right, the audit program is indeed that incredibly detailed how-to guide for the audit team. It ensures a purposeful audit rather than a scattered effort. Its formulation requires considering several crucial factors that shape the specific steps taken. Firstly, the nature of business in which the organization is engaged. The auditor simply should examine in detail the financial and accounting organization of the business by visiting the client's office, by observing different stages through which documents pass. For an industrial concern, visiting the factory is essential to understand processes of manufacture and quantitative records, for instance, how raw materials become finished goods. This is why CAP, in our earlier example, failed so badly. He lacked this fundamental understanding. The program must be technically, financially, and accounting-wise appropriate for that specific entity's operations. Secondly, the overall plan prepared for the audit. The audit program should be drawn up to ensure a systematic approach. This is crucial. If any divergence from the overall plan becomes necessary, first the overall plan should be modified, and thereafter only that specific matter may be taken in the audit program. The framework provided under the overall plan should be strictly adhered to. This emphasizes the top-down, hierarchical nature of audit planning and execution. The program is a detailed subset of the broader plan. Thirdly, the system of internal control and accounting procedures. This is a huge factor. You need to perform the study and evaluation of internal control to establish the reliance he can place on the internal controls in determining the nature, timing, and extent of his substantive auditing procedures. This involves reviewing the controls, evaluating them, and then testing their effectiveness. If internal controls are weak or unreliable, the magnitude of the task of the auditor increases considerably, leading to a much more extensive audit program with more substantive testing.
More work, basically.
Exactly. Fourthly, the size of the organization and structure of its management. Simply put, an increase in the size of the organization enhances the complexity, especially if it has multiple branches, subsidiaries, or diverse product lines. This directly impacts how the program is structured, the level of detail required for coordination across a larger, more complex entity, and the allocation of personnel. Fifth, information as regards organization of the business. The auditor needs to obtain a deep understanding of the client's history and business purpose and nature of engagement and time schedule. This initial intelligence gathering shapes the practical application of audit procedures and helps set realistic expectations for the program's scope and timeline. And finally, accounting and management policies. Reviewing past financial statements, especially from the immediately preceding previous year, reveals the client's accounting and management policies and their consistency. This provides a historical context that helps determine recurring audit procedures and flags areas where policies might have changed, necessitating new audit approaches or deeper scrutiny.
So armed with all this comprehensive information, how does the auditor actually draw up the program? Is it a fixed one-time document, or does it evolve, especially for a first-time audit versus a recurring one?
It's certainly not a static document. The audit program is a living document, particularly for a first appointment. The process for drawing up the audit program is typically a three-stage one. Stage one, broad outline. You start with a broad outline of the audit program. This is your initial blueprint, sketched based on your preliminary understanding of the client and the overall audit strategy. It's like planning the major sections of a book. Stage 2. Fill in the details. After the internal and accounting procedures have been reviewed, the details should be filled up on a consideration of the deficiencies in the system of internal control. This is where the rubber meets the road. If your evaluation reveals weak controls in a particular area, say inventory management, your program would then prescribe more detailed substantive procedures for inventory. This stage directly integrates your control assessment into your planned audit procedures. Stage 3. Add special procedures. After the detailed checking procedure is over, the extent to which the special procedures, first-time opening balance audit procedures, that are required to be applied should be determined. This could involve specific steps unique to initial engagements, like independently verifying balances of debtors and creditors, physically inspecting fixed assets, or reviewing specific industry-related provisions. For example, verifying tax liability for a shipping company, which are crucial for establishing opening balances in a first-time audit.
And for subsequent engagements, it's definitely not just a simple copy-paste job, is it?
Not at all. The program should be reviewed and, if necessary, modified each year based on the ongoing audit process and any changes in circumstances. This dynamic adjustment ensures its continued relevance and effectiveness. The key drivers for modification in subsequent engagements include the experience gained during the previous audits, allowing the auditor to refine procedures based on what worked or didn't, or what risks emerged unexpectedly. Then, important changes that have taken place in the business, especially in the system of internal control, accounting procedures, or in the structure of management or of the scope of business, as these changes would fundamentally alter the risk profile of the entity. And finally, the specific evaluation of internal control made for the current year, because control effectiveness can degrade over time, or new controls might be implemented. Think about practical triggers for modification. If the volume of turnover substantially increased, impacting the scale of desks needed, or if internal control procedures were not as effective as assumed during initial planning, requiring a significant shift towards more substantive testing. Other red flags include an extraordinary increase in the amount of book debts or that in the value of stocks, which indicates potential valuation or recoverability risks, or if a suspicion has aroused that assets have been misappropriated, necessitating investigative procedures. The audit plan and program must truly be reconsidered as the audit progresses based on new information and findings proving their adaptability.
Let's look at another test your understanding from your material. CA Purdueman is planning an audit and has listed various procedures, but plans to decide on the sample size at the time of performing those procedures. Is this approach proper?
No, this approach is not proper, and it's a common trap in exams. SA 300 states that audit plan shall include description about nature, timing, and extent of audit procedures. Critically, the extent of audit procedures also includes deciding about sample sizes to be tested for performing audit procedures. Therefore, deciding on sample size must be a part of the planning phase. It's not an ad hoc decision made only at the execution stage. This ensures a predetermined, structured approach to sampling, which is absolutely critical for obtaining sufficient appropriate audit evidence and managing audit resources effectively.
Okay, good to know. And another one. CA Nikita embarked on extensive procedures for foreign contributions, far more than originally planned, and is documenting the procedures and findings. But she doesn't feel the need to document how she planned the exercise. Does she need to refresh her knowledge?
Absolutely, yes. She needs to refresh her knowledge on this one. SA 300 requires auditor to document audit plan and significant changes made during the audit engagement to the audit plan. It also requires auditor to document reasons for such changes. Her failure to document the initial planning, and especially the reasons for the change and expansion in procedures for foreign contributions, is a critical lapse. Without that documentation, the audit itself becomes vulnerable. It could entail risk of not conducting audit according to professional standards in a qualitative manner. You lose that vital paper trail that explains why certain decisions were made and how the audit evolved. It's not enough to simply do the work. The thought process and rationale behind the audit plan must also be clear and properly recorded to ensure accountability and reviewability.
Right, document the why as well as the what. With the strategy set and the audit program meticulously laid out, we shift gears into audit execution. This is where the plan truly comes to life. Your material defines the key phases in the audit execution stage as execution planning, risk and control evaluation, testing, and reporting. Can you walk us through each of these practically?
Certainly. These 4 phases represent the practical, boots-on-the-ground implementation of the audit, turning strategy into action. First, we have execution planning. This isn't just a repeat of earlier planning, it's laying down the immediate tactical roadmap for audit execution to ensure timely and quality audit results. It involves refining the detailed audit program specific to the current week or month's work, defining immediate audit objectives, scope, and audit approach for that segment, and concretely considering manpower requirement, audit team qualifications, and the time element. A preliminary survey of the specific area being audited can help gather any last-minute information needed before diving deep. It's about optimizing the day-to-day work. Second, risk and control evaluation. For each specific segment of the audit, say, the revenue cycle or inventory auditors should conduct a detailed risk and control assessment. This means listing the inherent risks relevant to that segment. For example, risk of revenue overstatement, identifying existing controls or those that are needed to mitigate that risk, and then outlining the work steps required to test the effectiveness of the controls. This phase is intrinsically linked to materiality levels, as audit risks are assessed in relation to what is considered financially significant. You're constantly asking, what could go wrong and what's in place to stop it?
Evaluating the defenses, essentially.
Exactly. Third is testing. Once you have a comprehensive understanding of the key risks and the controls you intend to evaluate, auditors should test the operating effectiveness of the controls to determine whether controls are operating as designed. This is where you gather your evidence. Multiple test methods exist, like inquiry, asking staff, observation, watching a process, inspection, reviewing documents, and reperformance, doing the process yourself, to draw conclusions on control effectiveness and gather sufficient appropriate audit evidence. You're literally putting the controls through their paces. And fourth, the culmination is reporting. This phase involves synthesizing all the evidence gathered. SA 700, Forming an Opinion and Reporting on Financial Statements, establishes standards on the form and content of the auditor's report. The auditor meticulously reviews and assesses conclusions drawn from the audit evidence obtained to form their opinion on whether the financial statements are presented fairly. This includes ensuring they comply with the financial reporting framework, like accounting standards, and relevant statutory requirements, like company law provisions. The report provides a clear, concise, written expression of the auditor's opinion, promoting understanding and highlighting any unusual or material circumstances.
That paints a very clear picture of the audit flow. But your material also details other important considerations during execution, particularly regarding how the auditor leverages the work of another auditor, internal auditors, and an auditor's expert. This is where things get really nuanced, isn't it? Because despite relying on others, the primary auditor always retains sole responsibility for the final audit opinion. How do they navigate that balance?
That's exactly right. It's a delicate balance. Let's unpack those situations one by one.
So when does SA 600, using the work of another auditor, come into play? This standard is relevant when a principal auditor needs to use the work performed by another auditor for various components of a larger entity, like branches, divisions, subsidiaries, or joint ventures. Given the principal auditor still has sole responsibility for forming and expressing his opinion on the consolidated financial statements, how do they manage this reliance without diminishing their own accountability?
Right, this is a crucial area, especially in group audits, like a large bank with many branches, as we'll see. The principal auditor holds the ultimate responsibility for the overall report on the consolidated financial statements. However, they will be entitled to rely on work performed by others, provided he exercises adequate skill and care and is not aware of any reason to believe that he should not have so relied. SA 600 establishes specific standards for situations where the principal auditor's report incorporates financial information from components audited by another auditor. The key is that the principal auditor's responsibility isn't reduced. Instead, they must actively ensure the reliability and appropriateness of the work they rely upon.
So the principal auditor isn't just rubber stamping. What are the key procedures a principal auditor should perform when using the work of another auditor to ensure that reliability?
Think of the principal auditor as the orchestra conductor for the group audit. Their role is to ensure all parts are playing in harmony and hitting the right notes. This means undertaking several critical procedures. Firstly, setting the tempo and tone up front by communicating expectations. They must advise the other auditor regarding use of his other auditor, work and report, and make sufficient arrangements for coordination at the planning stage. This includes informing them about areas requiring special consideration, procedures for the identification of intercomponent transactions, and the timetable for completion of audit. This sets the stage for a well-coordinated effort. Secondly, they must ensure alignment on standards. They advise the other auditor of the significant accounting, auditing, and reporting requirements and obtain representation as to compliance with them. This ensures the other auditor is aware of and adheres to the same frameworks and professional standards as the principal auditor. Sometimes the principal auditor might even visit the other auditor to gain a direct understanding of their operations.
Face-to-face can help.
Definitely. Thirdly, they need to actively listen and review. They'll review written summary of other auditors' procedures, which could be a questionnaire or checklist detailing the work performed. This provides insight into the extent and nature of the work the other auditor undertook. Fourthly, they must address any discord. They'll consider the significant findings of the other auditor and potentially discuss them in depth with the other auditor and management of the component. This addresses any red flags or important observations that could impact the consolidated financials. Fifthly, they stand ready to jump in with supplementary procedures. If, after review, the principal auditor deems it necessary, they will apply supplementary procedures to obtain more assurance. These can be performed by either the principal auditor or the other auditor, acting as a safeguard if initial review indicates a need for more evidence. And finally, documenting every step of this reliance is crucial. They must document in his working papers the components whose financial information audited by other auditors, along with procedures performed and the conclusions reached. This ensures a clear audit trail and justification for reliance, which is vital for reviewability.
Coordination clearly seems vital throughout this process. How does that typically happen on a practical level?
You're absolutely right. Coordination is key. There should be sufficient liaison between the principal auditor and the other auditor. This can involve written communications to formalize expectations and instructions, ensuring everyone is on the same page. The other auditor, in turn, should coordinate with the principal auditor by bringing immediate attention any significant findings requiring to be dealt with at entity level and adhering to the timetable for audit of the component. They also need to confirm compliance with relevant statutory requirements. Conversely, the principal auditor should advise the other auditor of any matters that come to his attention that he thinks may have an important bearing on the other auditor's work, ensuring a continuous, two-way flow of critical information. It's a true partnership guided by the principal auditor.
What are the reporting considerations if there's an issue with the other auditor's work or if they've issued a modified report on their component?
This is where the sole responsibility truly comes into play. If, after performing their own procedures, the principal auditor concludes that the work of the other auditor cannot be used, and the principal auditor has not been able to perform sufficient additional procedures regarding the financial information of the component audited by the other auditor, then a qualified opinion or disclaimer of opinion must be expressed due to a limitation on the scope of audit. If you can't get sufficient appropriate audit evidence about a material component, you can't give a clean opinion.
Makes sense.
Furthermore, if the other auditor issues a modified report on their component, the principal auditor must carefully consider its nature and significance in relation to the entity's financial information as a whole. This consideration is crucial for deciding if it then requires a modification of the principal auditor's report on the consolidated financial statements. The principal auditor cannot simply ignore a qualified report from a component auditor if it materially impacts the overall picture. They have to assess its impact on their own opinion.
And the ultimate question, division of responsibility. Does the principal auditor become responsible for every detail of the other auditor's work?
No, absolutely not. The principal auditor would not be responsible in respect of the work entrusted to the other auditors, except in circumstances which should have aroused his suspicion about the reliability of the work performed by the other auditors. The principal auditor is not expected to re-audit the work of the other auditor from scratch unless specific red flags or suspicious circumstances emerge. The standard sets a threshold for when that additional scrutiny is required. To clearly delineate this responsibility to the users of the financial statements, the principal auditor's report should state clearly the division of responsibility. By indicating the extent to which the financial information of components audited by the other auditors have been included in the overall financial information. For instance, stating the number or proportion of branches or components audited by other auditors serves this purpose. However, if the principal auditor does notice any material discrepancies or issues that should have aroused suspicion, these must be brought to the knowledge of the other auditor and, if unresolved, incorporated into the audit report.
Okay, let's tackle test your understanding for. Here's Saurabh, the statutory auditor of BBI Bank relies on 134 branch audits. Wow. One large branch had errors in NPA, non-performing asset classification, which the branch auditor missed. The statutory auditor also reviewed internal inspection and concurrent audit reports, which didn't flag the issue. Is CA Saurabh liable here? What precautions should he take?
Okay, in this specific scenario, based on the information provided, nothing has come to light of statutory auditor which would arouse his suspicion about reliability of work performed by branch auditor. The fact that even the internal inspection and concurrent audit reports didn't flag the issue strengthens this position. Therefore, according to SA 600, CA Saurabh would not be responsible for work performed by branch auditor regarding the missed NPA classification errors. The key is that suspicion threshold. Without a reason to specifically suspect an issue, the principal auditor is entitled to rely on the component auditor's work. As for precautions, his audit report should clearly state that 3,034 branches of bank have been audited by branch auditors, thus explicitly indicating the division of responsibility. This disclosure in the audit report effectively communicates to the users of the financial statements the extent to which the principal auditor has relied on the work of others, fulfilling the requirements of SA 600 and clearly defining the scope of his responsibility. It manages expectations for the users.
Clear disclosure is key then. Hashtag tag 4.2, SA 610. Using the work of internal auditors. Now, switching gears to internal auditors, SA 610 governs the external auditor's use of their work. What's the critical distinction between internal and external auditors, and why does the external auditor still bear sole responsibility for the audit opinion?
The critical distinction, and it's a fundamental one, is independence. Neither the internal audit function nor the internal auditors are independent of the entity as is required of the external auditor. Internal auditors are employees of the very entity they are auditing, which inherently impacts their objectivity compared to an external, independent auditor. They report within the organization. Therefore, even if they perform procedures that appear similar to external audit work, the external auditor has sole responsibility for the audit opinion expressed, and that responsibility is not reduced by the external auditor's use of the work of the internal audit function or internal auditors to provide direct assistance. SA 610 defines specific, strict conditions that are necessary and the necessary work effort to obtain sufficient appropriate evidence to justify any reliance on internal audit work. It essentially provides a framework for the external auditor's judgments to prevent over or undue use of such work. You can use their work, but you can't offload your responsibility.
So given that fundamental difference, when can an external auditor even consider using the work of the internal audit function to modify their own procedures? What specific factors about the internal audit function need to be rigorously evaluated?
The external auditor must rigorously evaluate 3 core factors regarding the internal audit function to determine if their work is reliable enough to be used. Firstly, objectivity. This involves assessing the extent to which the internal audit function's organizational status and relevant policies and procedures support the objectivity of the internal auditors. You're looking for safeguards. Do they report to those charged with governance, like the audit committee, or a high-level officer with appropriate authority? Are they free from conflicting operational responsibilities? Are employment decisions affecting them overseen independently by governance? Secondly, competence. This evaluates the level of competence of the internal audit function. This refers to their collective technical knowledge, their training, their practical experience, and their adherence to professional standards. Do they have the necessary skills? And thirdly, systematic and disciplined approach. This assesses whether the internal audit function applies a systematic and disciplined approach, including quality control. You're looking at their methodology. Do they have documented internal processes, comprehensive work programs, clear documentation standards, and quality control policies similar to those required by SQC1 for external audit firms? Do they perform their work thoroughly and consistently?
And crucially, when can the external auditor absolutely not use their work?
If any of those 3 factors, objectivity, competence, or systematic and disciplined approach, are determined to be insufficient, the external auditor shall not use the work of the internal audit function for the purposes of modifying their own procedures. Your material makes a crucial point here. An organizational status and relevant policies and procedures that provide strong support for the objectivity of the internal auditors cannot compensate for the lack of sufficient competence. Equally, a high level of competence cannot compensate for an organizational status that do not adequately support the objectivity. All 3 elements must be sufficiently strong. A weakness in anyone is a deal breaker for reliance.
Okay, all 3 pillars need to be solid. How does the external auditor then decide the nature and extent of internal audit work that can actually be used? There must be safeguards to prevent over-reliance, right?
Exactly. The external auditor shall make all significant judgments in the audit engagement. To prevent undue use of internal audit work, the external auditor shall plan to use less of the work of the function and perform more of the work directly when certain conditions exist. Think of it as inverse proportionality. As risk or judgment increases, reliance decreases. This less use, more direct work approach applies when more judgment is involved in planning, performing procedures, and evaluating evidence. For instance, evaluating significant accounting estimates or assessing complex risks of material misstatement are significant judgments the external auditor must make themselves. You can't delegate your judgment. It also applies when the higher the assessed risk of material misstatement at the assertion level, with special consideration given to risks identified as significant. As per SA 200, higher risk demands more persuasive evidence, thus more direct work from the external auditor. Additionally, when the support for internal auditors' objectivity is lower or the competence of the function is lower, the external auditor should perform more work directly to compensate. Ultimately, the external auditor must always ensure that, in aggregate, their own involvement in the audit is sufficient, given their sole responsibility for the audit opinion expressed. This means they cannot outsource the entire audit or delegate their core judgments, regardless of the internal audit's capabilities.
Can internal auditors provide direct assistance to the external auditor, meaning literally helping them perform their external audit procedures?
Yes, internal auditors can provide direct assistance to the external auditor, but only if it's not prohibited by law or regulation. Even then, the external auditor must still evaluate the existence and significance of threats to objectivity and the level of competence of the individual internal auditors providing this assistance. It's not a blanket approval. Importantly, there are strict limitations. Internal auditors shall not be used to provide direct assistance to perform procedures that involve making significant judgments in the audit, such as assessing risks or evaluating the sufficiency of tests. Relate to higher assessed risks of material misstatement where the judgment required is more than limited. This reinforces the idea that the external auditor must handle high-risk, high-judgment areas directly. Relate to work with which the internal auditors have been involved and which has already been or will be reported to management or those charged with governance by the internal audit function. This prevents self-review threats.
Right. Can't review your own work.
Exactly. And they can't relate to decisions the external auditor makes regarding the internal audit function itself, like evaluating their competence.
Right.
Even for direct assistance, the direction, supervision, and review by the external auditor must be sufficient to ensure that the internal auditors have obtained sufficient appropriate audit evidence to support the conclusions based on that work. It's still the external auditor's responsibility.
Let's look at Test Your Understanding 5. C.A. Keshavraj is auditing Live with Nature Limited. The internal audit department has verified inventories and valuations. He attended the count and found no initial issues. However, he notices inventories are held for a considerably long period, and the internal audit reports haven't considered this. The company makes niche products for newborn babies, implying a high risk of obsolescence. Should he rely on the internal auditor's work for inventory valuation?
Okay, this is a fantastic example that illustrates the practical application of SA 610. Given the risk of inventory obsolescence due to changes in customer preferences for these niche products, this situation carries a significant risk of material misstatement and requires more judgment on part of statutory auditor, end quote. The internal audit report's failure to specifically consider the long holding period, especially with the niche product nature, is a major red flag that undermines their work's reliability in this specific area. Therefore, under SA 610, the external auditor, C.A. Keshavraj, needs to perform procedures directly for inventory valuation. This is a clear case where a higher assessed risk necessitates more procedures directly by the external auditor rather than relying on the internal audit's work. Such procedures could include comparing net realizable value of products with costs to verify completeness of provisions, recomputing of provisions for obsolete stocks, etc. The external auditor's judgment and direct procedures are crucial in areas of significant risk and complex estimates where internal audit's work shows gaps.
Okay, so direct action needed there. And illustration 1, where C.A. Amboj, an internal auditor, provides an inventory verification report to C.A. Kishore, the statutory auditor. Can CA Kishore rely on it?
Yes, CA Kishore can rely on it, but if he is satisfied about the appropriateness of the verification, WOTH, this means he must perform his own procedures to evaluate the adequacy of CA Amboge's work. This could include reviewing the internal auditor's work papers, observing some procedures, or reperforming a sample of their tests. However, and this is crucial, he must not rely on it if he finds that the verification is not in order, or if the work isn't appropriate for his audit purposes. The critical point, which your material emphasizes, is that the final responsibility to express opinion on the financial statement remains with the statutory auditor. This reiterates the external auditor's sole responsibility and the absolute need for their own independent evaluation.
Evaluation is always key. Hashtag 4.3, SA 620. Using the work of an auditor's expert. The final piece of this complex puzzle is using an auditor's expert. This covers situations where the auditor needs expertise outside accounting or auditing, like an IT specialist, revisiting CAB's initial concern, an actuary or a valuer. Again, the auditor retains sole responsibility for the audit opinion expressed. How can an auditor, who isn't an expert in that field, confidently accept an expert's findings as valid audit evidence?
This is where SA 620 provides the guidance. If the auditor, having followed this SA, concludes that the work of that expert is adequate for the auditor's purposes, the auditor may accept that expert's findings or conclusions in the expert's field as appropriate audit evidence. The key phrase here is for the auditor's purposes. It means the auditor doesn't become an expert in the field, but evaluates the adequacy of the expert's work as audit evidence. It's about ensuring the expert's work is relevant, reasonable, and reliable enough to support the audit opinion.
What are some practical examples of when an auditor might absolutely need to bring in an expert?
Your source lists several common scenarios where specialized knowledge beyond accounting and auditing is required. Valuation of complex financial instruments, land and buildings, plant and machinery, etc. Items where market values aren't readily observable. Actuarial calculation of liabilities, like for complex insurance contracts or defined benefit pension plans. Estimation of oil and gas reserves, where specialized geological or engineering knowledge is vital. Interpretation of contracts, laws, and regulations. This directly applies to CAB's fintech scenario, right?
Oh.
Understanding complex RBI or MITI regulations.
Yeah, exactly.
And also analysis of complex or unusual tax compliance issues, particularly in multinational or highly regulated environments.
That makes sense. But can an auditor gain enough understanding in an expert's field to simply avoid needing an expert?
Potentially, yes. An auditor who is not an expert in a relevant field other than accounting or auditing may nevertheless be able to obtain a sufficient understanding of that field to perform the audit without an auditor's expert. This understanding can be obtained through various means. Experience in auditing entities that require such expertise, education or professional development, or discussion with individuals possessing expertise. However, for matters that are particularly complex, involve higher risks of material misstatement, or where the auditor truly lacks sufficient background, using an expert often becomes necessary to obtain sufficient appropriate audit evidence. It's a judgment call based on the specific circumstances and the auditor's capabilities.
Okay. What are the primary considerations that should guide an auditor's decision to use an expert?
Key factors that influence the decision include whether management has used a management's expert in preparing the financials. If so, the auditor still needs to evaluate that work, which might inform the need for their own expert. The nature and significance of the matter, including its complexity. Highly complex matters often necessitate an expert. The risks of material misstatement in the matter. Higher risks generally increase the likelihood of needing expert help. The expected nature of procedures to respond to identified risks and the availability of alternative sources of audit evidence. If reliable evidence can't be obtained otherwise, an expert becomes critical.
How does the auditor then evaluate the expert's competence, capabilities, and objectivity? This sounds critical, given the reliance.
This evaluation is absolutely critical, and it's multifaceted. For an auditor's external expert, the auditor shall evaluate these factors. For objectivity specifically, the evaluation shall include inquiry regarding interests and relationships that may create a threat to that expert's objectivity. This involves discussing any financial interests, business or personal relationships, or other services provided by the expert that could compromise impartiality. The auditor also considers whether the expert is subject to technical performance standards or other professional or industry requirements, as this provides an indication of competence and quality. Threats to objectivity can also arise if the expert had a role in preparing the information being audited. In such cases, scrutiny needs to be higher.
And what about that crucial issue CAB faced? confidentiality requirements. This seems especially sensitive when you're bringing an external expert into a client's highly proprietary or sensitive systems.
You've hit on a very real and explicitly addressed point in FA 620. The need for the auditor's expert to observe confidentiality requirements is a matter that must be agreed upon. It is necessary for the confidentiality provisions of relevant ethical requirements that apply to the auditor also to apply to the auditor's expert. So the expert is bound by the same ethical standards. The entity itself may also request specific confidentiality provisions within the engagement terms, particularly crucial for a fintech company's sensitive data. Just as CAB worried, it must be clearly laid out.
Should there be a formal agreement with the auditor's expert? Is a handshake enough or something more specific required?
Your material states the auditor shall agree, in writing when appropriate, on several matters with the expert. This written agreement is crucial for clarity, setting expectations, and preventing misunderstandings. Matters include the nature, scope, and objectives of that expert's work, clear boundaries, the respective roles and responsibilities of the auditor and that expert, who does what, the form and content of the expert's report, ensuring it meets audit needs. And, as we just discussed, the need for the auditor's expert to observe confidentiality requirements, formalizing the obligation.
Once the expert's work is delivered, how does the auditor evaluate the adequacy of that work for their audit purposes? You're not the expert, so how do you know if it's good enough?
Right. The auditor's evaluation is critical here. It's about assessing the expert's output for audit purposes, not redoing their work. First, they evaluate the relevance and reasonableness of that expert's findings or conclusions, and their consistency with other audit evidence. This can involve inquiring of the expert, reviewing their working papers, and performing corroborative procedures like observing the auditor's expert's work, examining published data, confirming relevant matters with third parties, performing detailed analytical procedures, or even reperforming calculations if feasible. The auditor might also discuss the report with management or another expert if needed. Second, if the work involves significant assumptions and methods, the auditor must evaluate the relevance and reasonableness of those assumptions and methods. Are they generally accepted, consistent with the reporting framework? Third, if the work relies on source data, the auditor evaluates its relevance, completeness, and accuracy. Where did the data come from? What controls are over it?
What happens if, after all this evaluation, the auditor determines the expert's work is not adequate for their purposes?
If the work is not adequate, the auditor shall A. Agree with that expert on the nature and extent of further work to be performed by that expert, or B. Perform further audit procedures appropriate to the circumstances themselves. So you either go back to the expert for more or you step in yourself if possible. If the matter still cannot be resolved, which might even mean engaging another expert, it may be necessary to express a modified opinion in the auditor's report, because the auditor has not obtained sufficient appropriate audit evidence. The expert's work must be reliable enough to support the audit opinion.
And should the auditor generally mention the expert in the audit report?
Generally, no. The auditor shall not refer to the work of an auditor's expert in an auditor's report containing an unmodified opinion unless required by law or regulation to do so. Mentioning an expert could imply a division of responsibility that doesn't exist and mislead users. If required by law, the report must state that the reference does not reduce the auditor's responsibility for the audit opinion. That disclaimer is vital. If the reference is made because it's relevant to understanding a modification to the opinion, the same caveat applies. It, quote, does not reduce the auditor's responsibility, transparency without diluting accountability.
Okay, let's connect this back to theoretical question 8 from your material. XLTD had derivative contracts requiring fair evaluation by an external third party. The statutory auditors involved an auditor's expert who was new to them, and they didn't enter into a formal written agreement. Is this problematic?
Yes, this situation is definitely problematic from an SA 620 perspective. As per SA 620, the auditor should agree, in writing when appropriate, on crucial matters with the expert. This includes the nature, scope, and objectives, respective roles and responsibilities, and confidentiality requirements. Given that the expert was new to each other, a formal written agreement was especially prudent. While they may have developed a good bonding, a lack of formal agreement leaves critical aspects undefined. It could lead to misunderstandings about scope, reliance, or confidentiality. This absence potentially compromises the audit's effectiveness and defensibility. It's a risk easily mitigated with a clear written agreement.
So that good bonding isn't quite enough.
Not professionally, no.
Now, let's delve into what are often considered some of the trickiest areas in an audit. accounting estimates, especially fair value ones. Your material highlights estimation uncertainty and even mentions management bias. Why are these estimates so important, and what makes them inherently difficult to audit effectively?
Well, estimates are crucial because some financial statement items cannot be measured precisely but can only be estimated. Think about the useful life of an asset, a lawsuit provision, or complex financial instrument valuations. This inherent lack of precision leads to estimation uncertainty, which directly affects, in turn, the risks of material misstatement. What's fascinating and particularly tricky is that management bias, which can be unintentional or even intentional, can easily creep in precisely because accounting estimates are imprecise and heavily influenced by subjective judgment. Your material states the susceptibility of an accounting estimate to management bias increases with the subjectivity involved in making it. Auditors have to navigate this inherent subjectivity and uncertainty.
Can you give us some practical examples of financial statement items that commonly require accounting estimates, both general ones and those trickier fair value estimates?
Certainly. Your source provides a good range you'll definitely encounter. For general estimates about forecasting future outcomes, we see things like allowance for doubtful accounts, estimating uncollectible receivables, inventory obsolescence, estimating stock that won't sell at full value, warranty obligations for future repairs, the depreciation method or asset useful life, the outcome of long-term contracts, and financial obligations costs arising from litigation settlements, which can be highly uncertain. For fair value estimates, measuring current transaction value, examples include complex financial instruments, which are not traded in an active and open market, often needing sophisticated models, share-based payments, property or equipment held for disposal, and goodwill and intangible assets acquired in a business combination where valuation is often subjective. These often involve significant assumptions and unobservable inputs, increasing complexity.
Given this inherent uncertainty, what exactly is the auditor's objective with regard to these estimates?
The auditor's objective, as per SA 540, is clear: to obtain sufficient appropriate audit evidence whether accounting estimates are reasonable and related disclosures are adequate. This means ensuring management's best guess falls within a reasonable range, and that all necessary information about the estimate's uncertainty, assumptions, and methods is properly disclosed. It's about both the numbers and the transparency.
How does an auditor approach risk assessment specifically for accounting estimates? What kind of understanding do they need to gain?
The auditor approaches risk assessment for estimates by getting a very detailed understanding from management, building on SA 315. This involves understanding, firstly, the requirements of the applicable financial reporting framework relevant to accounting estimates, knowing the specific rules. Secondly, how management identifies those transactions, events, and conditions that may give rise to the need for accounting estimates. How do they even spot the need? This involves inquiries about changes in circumstances that may give rise to new or the need to revise existing accounting estimates. Thirdly, how management makes the accounting estimates, which is very detailed. This includes the specific method model used, relevant internal controls, whether an expert was used, the underlying assumptions, changes in methods, and crucially, how management has assessed the effect of estimation uncertainty. This deep dive is fundamental for assessing risks.
And what about looking at previous periods? Does reviewing past estimates help the current audit?
Absolutely. The auditor shall review the outcome of accounting estimates included in the prior period financial statements, or their subsequent re-estimation. This retrospective review is incredibly useful. It helps in identifying and assessing risks of material misstatement of accounting estimates made in the current period. If a prior estimate was consistently off, it might indicate issues with the process, data reliability, or even provide indicators of possible management bias if estimates consistently lean favorably for management. However, it's important that this review is not intended to call into question the judgments made in the prior periods that were based on information available at that time. The purpose is forward-looking, to inform the current audit by learning from past patterns, not to rejudge past decisions with hindsight.
Right. It's about informing the current audit. When an estimate is particularly complex or uncertain, giving rise to significant risks, what additional, more focused procedures are required from the auditor?
For accounting estimates that give rise to significant risks, the auditor must perform additional, more focused procedures to rigorously challenge management's approach. These include, Firstly, evaluating how management has considered alternative assumptions or outcomes and why it has rejected them, or how management has otherwise addressed estimation uncertainty. Did management rigorously consider possibilities? Secondly, evaluating whether the significant assumptions used by management are reasonable. This involves challenging key inputs, maybe comparing them to external data or benchmarks. And thirdly, evaluating management's intent to carry out specific courses of action and its ability to do so, if that intent is relevant to the estimate's reasonableness. An estimate based on unrealistic intent would be questionable.
What if, after all this, the auditor finds that management hasn't adequately addressed the inherent estimation uncertainty? What's the auditor's next step?
If, in the auditor's judgment, management has not adequately addressed the effects of estimation uncertainty on the accounting estimates that give rise to significant risks, the auditor shall, if considered necessary, develop a range with which to evaluate the reasonableness of the accounting estimate. This is a key tool. By developing their own reasonable range, the auditor can see if management's estimate falls within acceptable bounds. If management's estimate falls outside this range, it indicates a misstatement, and the auditor would need to propose an adjustment.
Let's consider theoretical question 7. An auditor requested information from a real estate company's management to review the outcome of prior period accounting estimates, like estimated costs for percentage completion. Management refused, saying this review shouldn't be done. How should the auditor advise them?
Management is absolutely incorrect here. As per SA 540, the auditor shall review the outcome of accounting estimates included in the prior period financial statements, or their subsequent re-estimation. This is an explicit requirement. The purpose is fundamental for identifying and assessing the risks of material misstatement of accounting estimates made in the current period. It helps identify indicators of possible management bias. Therefore, the auditor is entitled to this information, and management's refusal constitutes a limitation on the scope of the audit. If unresolved, it could impact the auditor's opinion.
So management can't just block that review.
No, they can't. Hashtag 5.2, SA 520, Analytical Procedures.
Moving on to another vital tool, analytical procedures. Your material focuses on their use as substantive procedures and for forming an overall conclusion. Can you first define what analytical procedures actually are?
Okay, the definition is key. Analytical procedures are evaluations of financial information through analysis of plausible relationships among both financial and non-financial data. This also includes investigation as is necessary of identified fluctuations or relationships that are inconsistent with other relevant information or that differ from expected values by a significant amount. It's essentially about finding patterns, trends, and anomalies, a plain professional judgment, looking at the big picture and asking, does this make sense?
So it's about spotting things that don't fit.
Yeah.
What are the key objectives of using these procedures in an audit?
The objectives are twofold and serve different purposes. Firstly, to obtain relevant and reliable audit evidence when using substantive analytical procedures. This is where you use relationships and data like comparing current year expenses to prior years to provide direct evidence for assertions about account balances. If the relationship holds true and is predictable, it can offer powerful evidence. Secondly, to design and perform analytical procedures near the end of the audit that assist the auditor when forming an overall conclusion as to whether the financial statements are consistent with the auditor's understanding of the entity. This is a crucial final review step, ensuring the big picture makes logical sense.
Can you give us a quick overview of how they are practically performed when used as substantive analytical procedures?
When designing and performing them as substantive procedures, the auditor follows a structured approach. Firstly, determine the suitability of particular substantive analytical procedures for given assertions. Not all accounts are suitable. Predictable accounts, like payroll, are often good candidates. Secondly, evaluate the reliability of data from which the auditor's expectation is developed. Crucial. If your data is unreliable, considering its source, comparability, and nature and relevance and controls over it, your procedure is unreliable. Garbage in, garbage out.
Right.
Thirdly, develop an expectation of recorded amounts or ratios and evaluate if it's sufficiently precise to identify a misstatement, setting a target range or value. And fourthly, determine the amount of any difference that is acceptable without further investigation. This is your tolerance threshold. How much deviation is okay before investigating?
And how do these procedures specifically help with the overall conclusion at the very end of the audit?
Okay. The auditor shall design and perform analytical procedures near the end of the audit that assist the auditor when forming an overall conclusion as to whether the financial statements are consistent with the auditor's understanding of the entity. These procedures are a high-level review, a final sense check. They are intended to verify conclusions formed during the audit of individual components, helping the auditor draw reasonable conclusions. Essentially, they provide a bird's-eye view, confirming the financials make logical sense given the auditor's knowledge. They might even spot a previously unrecognized risk, prompting further work.
What happens if these procedures identify fluctuations or relationships that are inconsistent with other relevant information, or that differ from expected values by a significant amount? What's the protocol then?
If such inconsistencies or significant differences are identified, crossing your acceptable threshold, the auditor shall investigate such differences by A. Inquiring of management and obtaining appropriate audit evidence relevant to management's responses, and B. Performing other audit procedures as necessary in the circumstances. This is a critical trigger for deeper investigation. These anomalies could signal a material misstatement or reveal an unrecognized risk. The auditor needs to corroborate management's explanations with other evidence. Management's word alone isn't enough.
Got to dig deeper.
Exactly.
Now, to bring everything we've discussed today together, let's turn to an integrated case scenario from your material. This involves CA, Anuti Auditing, an NSE-listed company that produces stationery. This is a perfect exam-style problem. CA Anuti has confirmed independence, verified integrity, sent an engagement letter, and is deep in planning. She's gathered business info, regulatory reports on the stationery market, info on government schemes, and the company's risk management policy. A key finding, inventories are substantial at plus 200 crore, making up 25% of total assets. So she's focusing on significant audit risks for inventory valuation and considering overall materiality. First question. The compliance with independence requirements and verification of integrity has been ensured by CA Anuti. In this regard, which of the following statements is likely to be a complete statement? Options relate to SA 220, 210, 300, and ethics.
Okay, this tests your understanding of preliminary engagement activities. The most appropriate statement here is that such activities are required to be performed in accordance with SA 220, and these preliminary engagement activities form part of planning an audit in accordance with SA 300. SA 300 explicitly lists preliminary engagement activities, which include performing procedures required by SA 220 regarding continuance and evaluating compliance with ethical requirements, including independence. So it's a combination of quality control, SA 220, and overall planning, SA 300.
Got it. Next, the auditor has obtained the risk management policy. Which statement is most appropriate? Options consider if it's required, helps identify risks, or is sufficient for the plan.
Understanding the client's risk management policy is essential. The most accurate statement is that understanding it is required by auditor. It may help the auditor in identifying risks of material misstatement that management failed to identify. This aligns with SA 315. Understanding the entity's risk assessment process helps identify significant risks. It's a crucial input, but it's certainly not sufficient on its own for the entire audit plan. It's a piece of the puzzle.
Okay. Third, which of the following is not likely to be a procedure for the auditor to understand the company? Options. Online searches, reviewing SEBI rules, reviewing money raised, seeking bank confirmations.
Right. This distinguishes understanding procedures from evidence procedures.
Yeah.
The correct answer is seeking confirmation letters from bankers regarding outstanding balances is not likely to be a procedure to understand the company in the general sense. This is a substantive audit procedure for evidence on specific balances, not a general understanding procedure done early on. The other options are valid ways to gain broader understanding during planning.
Fourth, considering auditors' intention to identify significant audit risks pertaining to inventory valuation, which statement is likely to be true?
This brings us back to estimates. The true statement is that the auditor's responsibilities regarding accounting estimates, like inventory obsolescence, are dealt with by SA 540. Given inventories are 25% of assets, valuation is material and involves judgment, especially for obsolescence. These are estimates. So SA 540 is the primary standard governing the auditor's work on inventory valuation here. It's about its true value, not just the count.
Okay, SA 540 for estimates. Finally, in relation to materiality levels for financial statements as a whole, which statement is most appropriate? Options relate to timing, before or after risk assessment or procedures.
This hits on a foundational concept. The most appropriate statement is that materiality has to be decided by auditor prior to identification and assessment of risks of material misstatements. SA 320 emphasizes that materiality is determined in the initial planning phase. This amount then guides subsequent risk assessment and the design of further audit procedures. It's a foundational decision setting the significance threshold.
Sets the bar early on. #outro. And with that, we've completed our comprehensive deep dive into audit planning, strategy, and execution. focusing on the standards on auditing your exam will cover. We've seen how the overall strategy guides the detailed plan, how crucial preliminary activities like independence checks are, and how the audit program provides the nitty-gritty instructions.
Mm-hmm. We also spent significant time understanding the nuances of leveraging the work of others. Principal auditors relying on other auditors, external auditors evaluating internal audit, or engaging experts. Crucially, we kept highlighting the external auditor's sole responsibility, even when relying on others. And we explored the challenges of auditing estimates, dealing with uncertainty and bias, plus the power of analytical procedures.
What stands out to me is how truly interconnected all these standards are. You simply can't separate planning from risk assessment or risk assessment from using an expert or how to audit an estimate. It's really a holistic, dynamic process, isn't it?
Indeed. It constantly demands professional judgment and critical thinking. And the ultimate takeaway for you, our listener, preparing for your exam, is that auditing isn't just about ticking boxes. It's about applying judgment, thinking critically, and adapting. The profession thrives on synthesizing diverse information and making informed decisions, especially with novel situations like that fintech company or complex estimates.
So what does this all mean for you as you prepare? It means understanding the why behind each standard, not just the what. It means being able to apply these principles to varied scenarios like the case studies and articulate your reasoning using the precise terminology. That's what will make you well prepared.
Right. And this raises an important question for you to think about as you study. In an increasingly digital and AI-driven world, what might be the next frontier in audit planning and execution? What will future auditors need to master, maybe even beyond the current scope of the standards? How will auditors assess the reliability of AI-generated financial data, for example? Or audit blockchain integrity? How will that reshape planning itself?
A truly provocative thought to leave you with. We hope this deep dive has provided you with the clarity, confidence, and deeper understanding you need for your upcoming exam and beyond. Good luck, and keep digging for knowledge.